Have you ever imagined making your money work for you, growing on its own without you having to do anything? It sounds too good to be true, but that's exactly how compound interest works. This simple yet incredibly powerful concept can be the key to multiplying your income and building wealth over time. You may have heard the famous quote attributed to Albert Einstein: "Compound interest is the eighth wonder of the world. He who understands it, earns it. He who doesn't, pays it." And this statement couldn't be more accurate. Compound interest is the key difference between those who consistently build wealth and those who remain stuck in financial cycles that lead nowhere. But what exactly is compound interest? Simply put, it's the process of your money growing on top of itself. Unlike simple interest, which is calculated only on the initial amount invested, compound interest generates interest on interest, creating a snowball effect over time. In this video, you'll discover exactly how this mechanism works and, more importantly, how to use it to your advantage to grow your wealth. We'll explore practical strategies, real-life examples, and investments that can turn small contributions into massive fortunes. To truly understand the power of compound interest, we first need to define how it works. Simply put, compound interest is the growth of your money, based not only on the initial amount invested, but also on the interest it has already generated. This means that over time, your earnings start generating their own earnings, creating an exponential effect. Let's compare it to simple interest for a clearer picture. Imagine you invest $1,000 at an annual interest rate of 10%. With simple interest, you would earn $100 per year, and after 10 years, you'd have $2,000. $1,000 from your initial investment and $1,000 in interest. Now, if that same amount were subject to compound interest, the growth would be much more significant. In the first year, you'd still have $1,100. But in the second year, the 10% wouldn't be calculated on just the original $1,000. It would be based on $1,100, resulting in $1,210. In the third year, the base amount increases again, and so on. After 10 years, instead of $2,000, you'd have around $2,600 without adding a single extra dollar. The formula to calculate compound interest is M equals C times 1 plus I, where M is the final amount, C is the initial capital, I is the interest rate, T is the time. This effect becomes even more powerful when you make regular contributions. And that's exactly how small investments can turn into massive wealth over time. If you've ever made a small snowball and rolled it down a hill, you know that as it moves, it grows larger and picks up speed. That's exactly how compound interest works with your money. The longer it stays invested, the greater its growth becomes. Let's illustrate this with a practical example. Imagine two people, John and Lucas. John starts investing $200 per month at age 20 with an annual return rate of 10%. Lucas, on the other hand, waits until he's 30 to start investing, contributing the same $200 per month at the same return rate. By the time they both reach 60, who do you think will have more money? The answer might surprise you. Even though John invested for only 10 more years, he would have accumulated approximately $1.1 million, while Lucas, who started a decade later, would have around $400,000. This happens because the early years of investing have a much stronger multiplying effect over time. This example proves one crucial point. Time is more important than the amount invested early on. The sooner you start, the better. Even if your contributions are small, time allows compound interest to work in your favor. One of the biggest mistakes people make is postponing investments, thinking they can make up for it later by investing larger amounts. But the later you start, the harder it becomes to achieve the same results. Now that you understand this incredible effect, how can we use it to our advantage in a practical way? Now that you understand how compound interest works and the impact of time on your investments, the big question is, how can we take full advantage of this effect to multiply our wealth? 1. Start as early as possible. As we saw in the previous chapter, time is the greatest ally of compound interest. Even if you don't have much money to invest, contributing any amount regularly puts you ahead of most people who delay this decision. 2. Stay disciplined and consistent. Many people start investing but give up along the way. The secret to benefiting from compound interest is consistency, investing every month no matter the economic conditions or market fluctuations. 3. Reinvest your earnings. Whenever your investment generates returns, avoid withdrawing them. Let your money grow and generate even more returns on top of returns. This is what accelerates wealth accumulation exponentially over time. 4. Choose the right investments. The type of investments you choose also matters. Assets with strong long-term returns, such as stocks, index funds, and certain fixed income investments, are ideal for maximizing compound interest. Sticking to low-yield options like basic savings accounts can limit your growth potential. 5. Understand compounding frequency. A crucial but often overlooked factor is how frequently interest is compounded. The more often your interest is reinvested, whether monthly, quarterly, or annually, the greater its impact. So, when choosing an investment, check how often the interest is applied, as this can make a big difference in the long run. At this point, it's clear that compound interest is a powerful tool for building wealth. But what about the psychological aspect? How can you stay patient and resist the temptation to withdraw your money before the right time? Knowing how compound interest works and investing regularly are essential steps. But there's an even more important factor: having the patience and discipline to let your money grow without interruptions. Many people start investing and after a few months or years feel tempted to withdraw their money too soon. Whether it's for an emergency or just to take advantage of short-term profits, this decision can sabotage decades of exponential growth. The secret of compound interest isn't just in investing, it's in how long your money stays invested. Think about how a tree grows. You can't plant a seed and expect it to become a huge tree overnight. Growth is slow at first, but after a few years, the branches expand and the fruits begin to appear. Compound interest works the same way. The first few years may seem slow, but over time, the growth accelerates dramatically. Another common mistake is waiting for the perfect moment to invest. Many people try to time the market, but the reality is that time in the market is more important than trying to predict short-term fluctuations. The earlier you start and the longer you keep your money invested, the greater your gains will be. This is where financial discipline comes in. Treating investing like a mandatory bill, setting aside a fixed amount every month, can make all the difference. After all, true wealth isn't built from a single large investment, but through consistency over the years. Now that you understand the power of patience, let's talk about where to invest to maximize the potential of compound interest. Blast off! Now that you understand the importance of compound interest and the mindset needed to take advantage of it, a crucial question arises. Where should you invest to get the best results? There are several investment options that allow compound interest to work in your favor. Let's explore the main ones. 1. Stocks of solid companies and index funds ETFs. Investing in the stock market is one of the most effective ways to benefit from compound interest. Well-established companies tend to grow over the years, and their dividends can be reinvested, further enhancing the compounding effect. Additionally, index funds like the S&P 500 ETF provide a simple and diversified way to invest in top companies without the need to pick individual stocks. 2. Fixed income securities with automatic reinvestment options like U.S. Treasury bonds or long-term corporate bonds allow interest earnings to be reinvested, maximizing gains over time. While returns may be lower than in the stock market, these investments offer stability and predictability, making them attractive for more conservative investors. 3. Real estate investment trusts. REITs. REITs are a great alternative for those looking to invest in real estate without buying physical properties. They pay regular dividends, which can be reinvested to speed up the compound interest effect. 4. Cryptocurrencies and digital assets, with caution. Despite their volatility, some cryptocurrencies and DeFi platforms offer passive income opportunities, such as staking and yield farming, where compound interest can also play a role. However, this type of investment requires research and a high risk tolerance. The key: diversification and reinvestment. The best strategy is to diversify your portfolio across these assets, adjusting your investments according to your risk tolerance. Most importantly, always reinvest your earnings to maximize long-term wealth growth. Now that you know where to invest, let's explore how to build an investment strategy that fits your financial goals. Blast off. Now that you know where to invest, how can you accelerate your wealth growth even further? There are several strategies that can enhance the power of compound interest and help you reach your financial goals faster. 1. Gradually increase your contributions. Whenever possible, increase the amount you invest each month. Even a small adjustment of 5% to 10% per year, in line with your income growth, can have a massive impact over the long term. 2. Minimize fees and unnecessary taxes. Many investors overlook the effect of trading fees, management fees, and taxes on their returns. Always look for low-cost investment options, such as low-fee ETFs and brokers that offer zero commission accounts. Additionally, in the US, accounts like 401ks and Roth IRAs provide tax advantages that can significantly boost your gains. 3. Automatically reinvest dividends and earnings. Many assets like stocks and REITs pay dividends. Instead of spending that money, set up an automatic reinvestment plan to ensure those earnings continue to compound over time. Choose investments with frequent compounding. Whenever possible, select investments where interest compounds more frequently, such as monthly or quarterly rather than annually. This accelerates your wealth accumulation significantly. By following these strategies, you can shave decades off your path to financial independence. Final thoughts. Taking action. Now, to wrap up our video, let's recap everything we've learned and discuss the next steps to turn this knowledge into action. Blast off. We've reached the end of this video, and now you understand how compound interest can be a powerful tool to multiply your wealth over time. We've learned that the key to compound interest is time and consistency. The earlier you start and the more disciplined you are with your contributions, the greater your future gains will be. We also explored the best investments to take advantage of this effect, such as stocks, index funds, bonds, and REITs. Plus, we discussed strategies to accelerate your growth, like reinvesting dividends, minimizing fees, and gradually increasing your contributions. Now, the most important question: what will you do with this knowledge? Understanding compound interest is just the first step. What truly makes a difference is taking action. So here's a challenge for you. Start today. Choose an amount, no matter how small, and invest consistently. Set a long-term plan and stick to it with discipline. Over time, you'll see your wealth grow exponentially. If you enjoyed this content, don't forget to like this video, subscribe to the channel, and share it with someone who also needs to learn about compound interest. See you in the next video. Blast off.